Margaret had been a customer at the same bank for 31 years. Same branch, same teller window on Tuesdays, same savings account. She'd fed every paycheck since her husband was still alive. And one afternoon in the fall of last year, she walked in to do something completely routine, something she had done dozens of times before, and the bank told her no, not rudely, politely even. A manager was called, forms were produced, and Margaret left that branch with her errand undone, her money untouched, and a sick feeling she couldn't name. Here's what makes her story worth paying attention to. She wasn't trying to do anything wrong. She wasn't being scammed. She wasn't confused. She was trying to manage her own money. Money she had earned, saved, and deposited into that institution over 3 decades. And the bank had developed a quiet internal policy that made what she was trying to do suddenly complicated. And here's what nobody told her. And what nobody may have told you is that this isn't a fluke. It isn't one bad branch manager having a difficult Tuesday. There is a broad, accelerating shift happening inside financial institutions right now, specifically aimed at customers over the age of 65. And the people most likely to be blindsided by it are the ones who have done everything right. So today, I want to investigate that shift with you. Not to scare you, not to send you sprinting to close your accounts, but because the specific mistake that gets seniors caught up in this, the one that turns a routine errand into a bureaucratic wall, is almost always the same, and it is almost always preventable. Let's find out what it actually is. Here's the question I kept coming back to when I started pulling on this thread. Why now? Banks have served elderly customers for generations. They've handled retirement accounts, Social Security deposits, estate transactions, all of it, without this level of friction. So why heading into 2026 are complaints from seniors about unexpected banking restrictions spiking? The answer starts somewhere most people would never think to look. Elder financial protection legislation. Over the past several years, federal regulators and state lawmakers have pushed hard to protect older Americans from financial exploitation. The statistics that drove that push are genuinely alarming. Fraud targeting adults over 65 has cost billions annually, and in many cases, the bank was the last place where someone could have stepped in and prevented the loss. So, legislators essentially told financial institutions, if you see something that looks like exploitation, you have not just the right, but potentially the obligation to intervene. That sounds protective, and it is in theory. The problem is, what happens when banks translate that obligation into internal policy? Because banks aren't social workers, they're not equipped to investigate every unusual transaction on a case-by-case basis with nuance and context. What they are equipped to do is build rule systems, flag thresholds, automated tripwires, checklists that generate alerts when certain patterns appear. And some of those tripwires have been set at levels that catch completely normal, completely legal senior financial behavior. A large cash withdrawal, a wire transfer to a family member, adding a name to an account, moving money between accounts in a pattern that doesn't match the customer's usual profile. Any of these individually can now cause a hold, a review, a conversation with a manager, or a flat refusal at institutions that have quietly tightened their internal playbooks. The customer never gets a memo. There's no FAQ on the website. The policy changes, and you only find out about it when you're standing at a counter, suddenly needing to prove that your own financial decision is legitimate. That's what happened to Margaret, and it happens every single day. But here's where it gets interesting, because the seniors who sail through these new friction points, they're not necessarily wealthier. They're not necessarily using private banking or having some special relationship. They're doing one specific thing differently, and we'll get to exactly what that is. First, though, I want to show you how deep this rabbit hole actually goes. To understand why certain transactions are getting flagged, you need to understand how a bank's compliance department thinks about risk. They're not thinking about you as an individual. That's not a criticism. It's just the reality of how large institutions operate. They're thinking about populations, patterns, statistical anomalies. Their job is to identify transactions that fit the profile of exploitation or fraud, and to do that across millions of accounts simultaneously. So they build what's called a behavioral baseline for each customer. It's essentially a financial fingerprint. Your usual deposit amounts, your typical withdrawal size, how often you use the branch versus online, who you typically transfer money to. Normal variation within that profile, no problem. A sudden departure from it that triggers a review. Now, here's where seniors specifically run into trouble. Retirement is, by definition, a massive behavioral shift. Your deposit patterns change. Maybe a pension replaces a paycheck, or Social Security starts coming in, or you begin drawing from a 401k or IRA systematically. Your transaction size might increase because you're making larger, less frequent purchases. A vacation, a home repair, helping a grandchild with tuition. You might start moving money in ways you never did during your working years. Every one of those shifts can look to an automated compliance system like a red flag. And it gets more complicated because at the same moment your behavior is legitimately changing, the kinds of fraud targeting your age group are also increasing. Grandparent scams, fake IRS calls, romance fraud, sweepstake schemes. These are real. They are sophisticated, and they often involve the victim going to the bank and making a large withdrawal. Sometimes even telling the teller a story that the criminal coached them to say, "Banks have seen that movie. They're trying to stop it." But the side effect is that a legitimately retired person who wants to withdraw a significant sum to, say, help pay for a grandchild's emergency medical bill or move money into a different account they've decided to open or send funds to an adult child they support can get stopped at the teller window. And here is the specific mistake that makes this dramatically worse. It's not the transaction itself. It's the documentation situation around the account, or more precisely, the lack of it. Pause. When a bank can't quickly verify that a large or unusual transaction is legitimate, when there's no authorized signatory on the account, no power of attorney on file, no trusted contact designation, no established pattern of communication with a family member or advisor, the path of least resistance for a compliance-minded institution is to slow everything down or stop it entirely. The customers who don't get stopped are almost always the ones who have already built what I'd call a credibility infrastructure around their accounts. It's not complicated, but most people have never been told they need it. And that is the mistake we're here to fix. Let me be specific about what that mistake looks like, because it comes in a few different forms. Mistake 1, the solo account with no documentation of intent. This is the most common. A senior has 1 or 2 bank accounts, maybe a checking, maybe a savings, held solely in their own name with no power of attorney on file with the institution, no trusted contact designated, and no beneficiary designations updated in years. The account is legally theirs. They have every right to it. But from the bank's perspective, if something looks unusual, there's no one to call for context. There's no pre-established relationship with an advisor or a family member. There's no paper trail showing that this customer in advance authorized this type of transaction. When a compliance flag fires, the bank's options are approve it anyway. Risk, hold it, friction, or decline, safety. More and more institutions are choosing friction or safety. Mistake 2, doing large transactions without a conversation first. Banks have become far more comfortable intervening when large sums are involved and far less comfortable moving fast without a clear narrative. The seniors who sidestep this understand something important. Calling ahead or sending a brief written instruction to the branch before a big transaction changes how it's processed. It turns a surprise into an expectation. Compliance teams respond very differently to a flagged transaction that's already been discussed with the branch manager versus one that appears without context. This sounds like extra work, and it is slightly, but the alternative is showing up trying to move a significant sum and being told you need to come back in 3 business days after a review, or that additional verification is required that you didn't bring with you. This is the one that most people have genuinely never heard of. In 2018, financial industry regulators introduced a requirement for brokerage firms, and many banks followed suit voluntarily to ask customers to designate a trusted contact. This is not the same as a beneficiary. It's not the same as a joint account holder. It's simply a person the institution is allowed to call if they have concerns about your account activity or your well-being. You control whether they can call that person. That person cannot make any transactions on your account. They can only be contacted for verification. But here's the thing. Customers who have a trusted contact on file get treated differently when a flag fires. There's a human to reach. There's context available. The bank can quickly determine whether you're acting freely and intentionally rather than defaulting to a hold. If your account has no trusted contact designated, you've removed one of the fastest ways for a bank to resolve a compliance question in your favor. 3 mistakes, all of them invisible until the moment they matter. And at that moment, they matter enormously. Now, I want to pull the camera back a little because there's a second dimension to this story that most people aren't connecting. It's not just internal bank policy. There are regulatory changes in 2026 that are affecting how specific types of transfers are processed, particularly wire transfers, and certain transactions when the account holder is over 65 and the destination is a non-institutional recipient. Here's what that means in plain language. If you are moving money to another bank account, to a family member, to a financial advisor, to a real estate transaction, certain institutions are now applying enhanced review protocols specifically because of the combination of your age bracket and the transfer type. This isn't discrimination in the legal sense. It's categorized as elder financial protection under several state-level regulatory frameworks that have gone into effect or expanded coverage in 2025 and 2026. The intent again is protective. The execution again has friction baked in. One specific area that's generating a lot of confusion right now, transfers made in connection with estate planning. If you're working with an attorney to set up or fund a trust, if you're retitling assets as part of a Medicaid planning strategy, if you're gifting assets to family members as part of a legal estate reduction plan, these are all legitimate, common, professionally guided financial activities. There are also activities that can trigger elder financial exploitation flags. because they involve moving significant sums, often to people the bank has no prior record of receiving your money. The frustrating irony is that the people most likely to be doing these things correctly, working with attorneys, following professional advice, acting with full legal authority over their own assets, are sometimes the people most likely to get stopped because their transactions look bigger and less routine than someone who's just making small, steady withdrawals. The workaround, and there is one, involves something called an attorney letter of instruction. When your estate planning attorney provides written communication directly to your financial institution, confirming the nature of a planned transaction series, most institutions will create an internal note that clears those transactions for a defined period. This one step, which takes your attorney maybe 15 minutes to produce, can eliminate weeks of friction, holds, and repeated verification requests. Most people never ask for it. Most attorneys, unless they regularly handle elder law, don't think to offer it automatically. Now, we're getting to the part of the investigation that actually surprised me because it's not just what banks are doing. It's what some seniors are accidentally doing that makes the situation worse. This is the part of the story where I need you to really pay attention because there's a category of financial behavior that many seniors fall into, not out of carelessness, but out of completely understandable instinct that creates exactly the wrong impression with automated banking systems. It goes like this. A senior becomes aware that they need to reorganize their finances. Maybe a health scare prompted it. Maybe a friend went through probate and it was a nightmare. Maybe they watched a video, talked to a sibling, read something, and they decide, I need to move some things around. I should consolidate. I should simplify. So they start making a series of moves. Closing an old account here, opening a new one there, transferring a balance, withdrawing cash to pay off a grandchild's tuition directly, moving money to a trust account they just set up, making a gift to a family member. These are all reasonable things. These are all things their estate planning attorney might have told them to do. But here is what it looks like to a bank's compliance algorithm. Multiple account changes in a compressed time period, irregular withdrawal amounts, new external transfer destinations, cash withdrawals followed by online transfers. This pattern, when it appears in an elderly customer's account history, scores very high on what compliance systems call a behavioral anomaly index, which means that by the time you walk into the branch to complete step 3 or step 4 of your perfectly legitimate financial reorganization plan, you may already be flagged. The teller doesn't know that. The branch manager may not know that, but somewhere in the institution's back-end system, your account has accumulated enough anomaly points that the next unusual transaction could trigger a hard stop. This is not a conspiracy. This is not the bank trying to steal your money or deny you access. It is an automated risk system doing exactly what it was designed to do, imperfectly. And the solution is almost embarrassingly simple. But it requires doing something before you start making moves, not after. You notify the bank, not informally, not verbally at the teller window, but in writing a brief signed letter, ideally co-signed or referenced by your attorney, that tells the institution, over the next 90 days, I'm undertaking a planned financial reorganization that will involve the following types of transactions. This activity is intentional, legally guided, and does not represent a change in my circumstances or a response to outside pressure. Banks have a process for receiving and logging this kind of notice. It doesn't guarantee frictionless processing, but it dramatically reduces the probability of a hard stop. It moves your account from flagged anomaly to documented intentional activity. The people who know to do this, they tend to be working with elder law specialists, attorneys, and financial advisors who understand not just the legal moves, but the banking friction that surrounds those moves. The people who don't know to do this tend to find out the hard way in the middle of a transaction they needed to complete yesterday. Let me bring this investigation to its conclusion. Here's what I believe is actually happening based on everything I've pulled together. We are in the middle of a generational shift in how financial institutions interact with older customers. The regulatory pressure is real. The fraud problem it's responding to is real. And the resulting friction, the extra review, the documentation requirements, the holds, the polite but firm branch manager conversations is not going away. If anything, the infrastructure for this kind of monitoring is going to become more sophisticated and more widespread in the next few years. What that means for you isn't panic. It means preparation. Specifically, 5 things you can do right now, most of which take less than an hour, that will dramatically reduce your exposure to unnecessary banking friction. Number 1, call your bank and designate a trusted contact today. The single step costs you nothing and gives the bank a path to quickly resolve any compliance question in your favor. Choose someone who knows your financial situation and can be reached reliably. You can update this designation at any time. Number 2, put a durable power of attorney on file with every financial institution you use, not just with your attorney, not just in your files at home. The institution itself needs a copy on record, and it needs to be accepted and logged by them before you ever need it. Call ahead and ask what their POA acceptance requirements are because they vary. Number 3, if you are planning any significant financial reorganization, moving assets, funding a trust, making substantial gifts, tell your bank in writing before you begin. One letter, one conversation with your branch manager. That context can be the difference between a smooth process and weeks of holds and reviews. Number 4, ask your estate planning attorney for a letter of instruction directed to your financial institutions. If they're not familiar with providing this, find one who is. Elder law attorneys do this routinely and understand how banking compliance departments operate. Number 5, review your account beneficiary designations now, not when something forces the issue. Outdated beneficiaries, especially after a spouse is passing or a major life change, create confusion that can compound during estate administration and can sometimes trigger identity verification issues while you're still living. None of these require you to change banks. None of them require you to restructure your entire financial life. They are documentation moves, small, unglamorous, quiet actions that build the credibility infrastructure I mentioned earlier. The irony of this entire situation is that the seniors who get stopped at the bank counter are almost never doing anything wrong. They're managing their money. They're planning for the future. They're doing exactly what responsible people do. But they're doing it in a financial environment that has quietly changed the rules without sending a memo. I want to come back to Margaret for a moment. She did eventually sort out her situation. It took 3 visits, 2 phone calls, and a letter from her attorney. The transaction she needed to complete, the one that was completely legal, completely hers to make, ultimately went through. But here's the thing she said afterward, and it's the thing that stuck with me. Lower voice. I've been taking care of my own finances for 60 years, and I walked out of that bank feeling like a suspect. That feeling, that sudden disorienting loss of agency, is what this is really about. Not just the paperwork, not just the compliance systems. It's the experience of having quietly built a life, accumulated resources through decades of discipline, and then finding that the institutions meant to hold those resources have developed new gatekeeping behaviors that you were never warned about. You don't have to accept that as your story. The 5 steps I walked through today won't guarantee that you never encounter friction. The systems are imperfect, and they will remain imperfect, but they will make you, in the eyes of your financial institution, someone who has already answered the questions before they're asked. And in a world where the questions are being asked more often to more people with higher stakes, that is not a small thing. The mistake isn't moving money. The mistake is moving money inside an institution that has no context for who you are and what you're doing. Change that context before you need it. Beat. That's the investigation.